Hello, everyone. I'm Jean-Claude at Beyond Mystic, and welcome to this very special Sunday report. Banking failure, SVP, special report with Jsnip4, Big Weir, and David Morgan. Let's go through the introductions. Mr. David Morgan, you can find him at themorganreport.com. He is the author of the Silver Manifesto. Mr. Morgan, welcome back to the show. How are you?
Thank you. I'm well.
Glad to have you on. Next, of course, is Mr. Bix Weir. You can find him at roadtoruta.com. Bix, welcome back. How are you?
I'm doing well. Bonjour.
Bonjour. A little bit of French for you guys. And of course, my buddy Jsnip4, the treasure hunter extraordinaire. You can find him at patreon.com/Jsnip4. Joe, welcome back to the show. How are you?
Good, doing good.
Good. Thank you so much, everyone, for joining us here on this live chat. We are here right now, currently simulcasting on both Jsnip4's and my YouTube channel. We're going to do that for a couple of minutes here. We're going to set the stage for you guys here, rewinding to 2008. And once we've done the intro, we're going to cut the feeds here on YouTube, guys, and we're going to move over the conversation to our Rumble channel, where I see a bunch of people in the live chat now. Let me bring a link down for you here in this live chat in case you're watching on YouTube, as this feed on YouTube will disappear here in about 10 minutes or so. So you want to join us now on the Rumble chat. Guys, before I start, Mr. Morgan, I have you on the screen here. Can we just go back down memory lane and quickly explain what happened in 2008, what was happening at the banking level with the mortgage-backed securities, and how that eventually created this contagion effect that the Federal Reserve and other institutions around the world had to jump in to create these bailouts. Let's start there to set the stage for the audience members this evening. Let's put that into perspective for us, please. Mr. Morgan.
Well, the 2008 crisis was largely subprime mortgages. And there was a joke that was pretty accurate that if you could fog a mirror, you could get a loan.
Right.
So there were, you didn't have to have an income proof. You didn't have to have asset proof. You just said, yeah, I can make these payments, and the banks are giving you loans. So at about that time, there was the idea that you could package together loans and make them into a security and then sell them to an investment bank, for example, insurance company, pension.
Can you mute your mic, JC?
Yep.
So what took place was the truth came out eventually. Well, let me back up a second. So some of these securities were overrated. In other words, Moody's, some of the rating agencies were putting them in as, A or AAA or whatever, when in fact they weren't. And beyond that, they put together a lot of subprime mortgages with better grade mortgages and combined them and called them different names. So the truth of the matter was, they gave a lot of loans that should have never been given. The idea being, it really didn't matter because real estate always goes up, and then inflation would take care of it, and the whole thing came unraveling. And the best way to look at it, really, without any of my editorializing, is to watch The Big Short. The Big Short is pretty much more almost a documentary on what actually took place. So the truth came out. You couldn't borrow indefinitely, and that scene in there. I guess I can say anything on this channel now. I think this is clean enough. But when one of the investment bankers from New York, hedge fund guy, goes down to Florida to see what's going on with this real estate bubble, and they're talking to this stripper, and she's got like 5 properties. It's when he goes berserk and says, this is crazy. So I think hopefully that's a good enough summation. I mean, we can go into more detail. The big idea is loans that should never have been given out were given out. The premise being wrong that real estate always goes up, and at some point the piper had to be paid, and that wrapping these things together and making them as if they're good stuff when they really were. I think in the movie he says dog crap squared or something.
Right. Exactly. Thank you for that. I appreciate that. Let me bring you up on the screen also, Bix here. Just to add a little bit of context, there was a lot of indications that we were heading into problems before it happened in 2008. And of course, in The Big Short, we're talking about that here. There were people out there saying, hey, there's a big issue if you look under the hood. Yet nobody wanted to look at it. But eventually, as Mr. Morgan said, we had to pay the piper here. Explain those signals, and perhaps later in the show, we'll extrapolate those signals that we were having in 2006, 2007, and how those are correlated to the ones that we've been seeing and reporting here also on roadtoruta.com. Go ahead, Bix.
Well, sure. I mean, I think that the biggest signal right before that was probably the Bear Stearns collapse in March, where Bear Stearns, one of the biggest investment banks in the country, literally went down over a weekend. Very similar to what just happened with the Silicon Valley Bank. There were rumors it was about the silver position. We do know that JP Morgan took over their silver position and had to get a $30 billion guarantee from the Fed to do that. Everybody was talking about, they bought them for $2. They got it cheap. A lot of people said that it was JP Morgan that put them in that position, which you're hearing right now about Silicon Valley Bank. JP Morgan was knee deep in saying, everybody get out of Silicon Valley Bank. Well, if all the bankers said, let everybody get out of JP Morgan would implode overnight as well. So very similar goings on. And it was March of 2008 when Bear Stearns went down and leading to the September 11th, 2008 big money pull out of the money market funds. I think it was $500 billion. And that's when Ken Jaworski said, we had a matter of hours before the system would go down. I think Janet Yellen was facing that just now. And
okay, you're going a little bit too fast. Yes, so there's a couple of things there too. We'll play the clip here. Actually, while you just mentioned it, let me bring this up for the audience members here too, because not only were there warnings, but after the fact, a lot of people just went back to bed, not knowing how close it came to having a big issue on that Monday morning. Even though you, myself, and Joe have been talking about this, it kind of sounded like quarterbacking or Monday morning quarterbacking. As opposed to what Republican Paul Jaworski has to say in this clip. So let's play this for the audience members, and I'll ask you guys for your commentary afterwards.
At about 11 o'clock in the morning, the Federal Reserve noticed a tremendous drawdown of money market accounts in the United States to the tune of $550 billion was being drawn out in a matter of an hour or two. The Treasury opened up its window to help. They pumped $105 billion in the system and quickly realized that they could not stem the tide. We were having an electronic run on the banks. They decided to close the operation, close down the money accounts, and announce a guarantee of $250,000 per account so there wouldn't be further panic out there. And that's what actually happened. If they had not done that, their estimation was that by 2 o'clock that afternoon, $5.5 trillion would have been drawn out of the money market system of the United States, would have collapsed the entire economy of the United States, and within 24 hours, the world economy would have collapsed. Now, we talked at that time about what would happen if that happened. It would have been the end of our economic system and our political system as we know it. And that's why, when they made the point, we've got to act and do things quickly, we did.
Okay, thank you so much. And there's another clip I want to play. I believe you and I, Bix, talked about this on the show, maybe in January. It was this, and I know that Mr. Morgan also retweeted this, I believe, on his Twitter. This was a interview between a bunch of bankers who were talking about the FDIC and the fact that in the near future here, depositors were going to face major haircuts. And now they were debating on whether or not to alert the public of these upcoming haircuts. Their biggest concern, of course, being that could and would create an even bigger bank run. Am I characterizing that? Okay, let me bring you up on the screen again here, David, for that one. How did you see this particular video play out? And how is that an indication to perhaps what is about to play out here in the following days and weeks? Mr. Morgan.
Well, obviously it's opinion, but I think it's self-evident. I mean, basically what this guy is saying is that expect bank runs. And, it's going to happen. I mean, it's pretty clear that they're well aware of what's taking place ahead of this event that we're going to be discussing later.
Okay, very, very good. Thank you so much. Joe, just to bring you in, to chime in to this introduction as well, you produced a video earlier today, or I believe yesterday, about the Basel III regulations and the fact that if SVB was in fact one of those tier 1 banks. Explain that quickly here for the audience members. What did you mean by that? And set that up for the audience. Joe.
Yeah, so the Basel system, it's their Basel 1, Basel 2, they're going to move to Basel 3. We're going to make adjustments to how banks should operate and lending and all this shit and how much assets and how much, whatever debt to asset ratios, all this crap. And they want tier 1 capital banks to have 6% ratio. So that's not a whole hell of a lot to begin with, to tell you the truth. But the bottom line is this bank that failed, SVB or whatever, had more than double the Basel III requirement. In Basel III, they haven't really, no one's actually technically signed up just yet. It's coming. So I didn't decide to look up, well, what's Basel II? It's probably similar, 4%, 5%, 6%, I don't know. But this thing had I think it was around 15%, 14 or 15%. So in the eyes of the financial world and what they want the public to know is this is a tier 1 bank. Again, this is the triple rated mortgage-backed securities. These are the best things. We sell these. They're not going to implode. And then we find out they were filled with shit. Bankruptcy, foreclosures and all this other shit that the Fed just stepped in and we'll give you 100%, cents on the dollar. So we have a system that says if you're at the very tippy top, this is the numbers, just for example, and the numbers we're seeing from these banks, by the way, everybody, are double what our requirement is. Now, if I'm the citizen, I hear that makes me feel great. So we have a number, and these guys are double? Oh. And that bank failed. Mm-hmm. And you look at all the other banks, they just have more money. And again, I showed you little ratios. It's about 40 to 50%, their debt obligations or whatever, their debt to their assets. It's like, it's the same thing. Okay, JP Morgan has $3.5 trillion deposits, but they got $1.5 trillion, on the debt side. If this bank had $220 billion, they had a little over $100 billion, whatever, in debt. So again, it's just the same little ratio. Everything's fine. These AAA, best triple, quadruple rated banks, everything's great. Tier 1, tier whatever. There's these stupid words and terms. This whole financial thing is just a smorgasbord of weird words and things they make up. Mortgage-backed security, reverse repo. I mean, this thing is so convoluted, it can't continue. Mm-hmm. And that's why I think this is happening right now. And by the way, I don't think this was a deep state operation.
Mm-hmm. Okay. Well, thank you so much, Joe. We'll get into that in a moment here as we start broadcasting here on the Rumble channel. We see people in the live chat now. So folks, let me just bring down the link again here for the Rumble channel here. We're about to start there in earnest with No Holes Barred.